When you first decide to invest your savings, the stock market can feel entirely overwhelming. There are thousands of tickers, flashing screens, and a dizzying pace that makes it hard to know exactly where to safely put your money to work. But if you strip away all that noise, the decision for most everyday investors actually boils down to just two main paths. The first, and oldest, is the mutual fund. Think of this as a massive shared pot of money, where you and thousands of other people pool your cash, and a traditional Wall Street institution takes the reins. They assign a professional manager to actively run that pot. This person's entire job is to research companies, buy the ones they think will climb, sell the ones they think will fall, and ultimately try to outsmart the market. The second option is the index fund. This approach skips the human manager completely. It's an automated system that simply copies a fixed list of top companies, like the S&P 500. So your choice right out of the gate is clear. Do you pay for human expertise to try and beat the system, or do you rely on a quiet, automated mathematical average? It is incredibly tempting to hand your hard-earned money over to a Wall Street professional. Having an expert at the wheel provides a deep sense of security when you're dealing with your life savings. But that security comes with a specific recurring cost, called the expense ratio. To cover the massive research budgets and salaries of those human managers, actively managed mutual funds will charge you anywhere from 0.5% to 2% of your total investment, and you pay that fee every single year. It gets deducted whether the fund manager has a spectacular year or whether they completely tank your portfolio. If you have $10,000 invested in a mutual fund, $50 to $200 of that disappears annually just to cover their operational costs. Before you even see a single dollar of profit, you are guaranteed to pay a structural tax for the privilege of their active management. Now let's look at the alternative. Index funds sidestep that structural tax entirely by removing the human manager from the equation. Instead of paying someone to guess which stocks will win, an index fund automatically buys a tiny piece of the 500 biggest companies in America all at once. No stock picking, no daily trading, no human decisions. Because the process runs on autopilot, the fees drop to almost nothing. You'll typically see expense ratios between 0.03 and 0.2%. Notice what happens over 30 years when comparing a 2% mutual fund against a 0.05% index fund. That widening gap represents tens of thousands of dollars paid to Wall Street instead of compounding for your retirement. There is a trade-off, of course. By holding an index fund, you give up the fantasy of beating the market average. You will only ever earn exactly what the broader market earns. But when you are building wealth over decades, keeping your fees near zero is a mathematical certainty you can actually control, whereas chasing a hot stock picker is always a gamble. So the central question is, does paying that 1 or 2% premium to a mutual fund manager actually get you higher returns? We don't have to guess. We have decades of historical data tracking exactly how well active Wall Street managers perform against a passive S&P 500 baseline. This chart shows the harsh reality for professional stock pickers. Over any 15-year period, roughly 90% of actively managed mutual funds fail to beat the index. They fail primarily because of that heavy fee drag we looked at earlier. A manager has to perform significantly better than the market every single year just to break even after their own costs are deducted. And secondly, the stock market is relentlessly erratic. Even the most educated financial experts cannot consistently predict the future over a decade and a half. When you hand your money to an active manager, you are paying a high premium for a strategy that mathematically loses to a simple, automated system 9 times out of 10. This data is so compelling that Warren Buffett, widely considered one of the most successful investors in history, has weighed in on the debate. Despite building his entire massive fortune by picking individual stocks, he publicly advises everyday people to completely avoid trying to do the same. He has stated on the record that for most people, buying and holding a low-cost S&P 500 index fund is simply the best investment they can make. The very champion of active, deep research investing advocates for the most boring, hands-off approach possible for the general public. If the ultimate financial insider looks at the data and concludes that the automated math of the index is unbeatable, it's a strategy worth trusting. So, how do you actually apply this data to your own savings? If you are a beginner looking to build long-term wealth, the path forward is remarkably straightforward. Open an account with a major brokerage like Vanguard, Schwab, or Fidelity, and select a broad, low-cost S&P 500 index fund. Once that is set, arrange for automatic monthly contributions directly from your bank account. Then, log out and ignore the daily financial news entirely. You can even find specific funds today, like Fidelity's Zero Line, that have eliminated the expense ratio completely, meaning every cent of your money stays invested. For the vast majority of us, the portfolio that will generate the most wealth over time is the one that requires the absolute least amount of human meddling. Now, does this mean mutual funds are entirely useless? Not quite. There are specific advanced scenarios where paying that active manager makes sense. If you are managing a complex portfolio and need exposure to very difficult-to-navigate international markets or highly specific volatile industry sectors, you might genuinely need an expert guide. In those rare instances, you are paying the high fee simply as a toll for access to that niche market, not because you expect the manager to magically beat the broader stock market. But for your core savings, the choice is clear. Mutual funds come with high fees and a manager attempting the impossible. Index funds copy the market, run on autopilot, and cost you almost nothing. At the end of the day, your goal is to compound your own personal wealth, not to pay Wall Street managers to guess the future.